G'day traders, let's see where the smart money is flowing today. I am your host, and today we are doing a proper deep dive into the biggest corporate car crash in history. We are tracing the full story of Lehman Brothers, from a small shop in Alabama to a $600 billion collapse. We'll expose the secret accounting tricks they used and the exact moments that the most famous investors walked away. Then, we are comparing those 2008 vibes to our current market highs to see if we're in another bubble. Disclaimer first, this script is for education and entertainment only. I'm not a financial advisor, so do your own research. The big question is, with tech hitting record highs today, is the global banking system actually safer than it was back then? Drop a comment with your take, hit like, and subscribe to Goldie Gains so you never miss a golden entry. Our story starts way back in 1844, when a German immigrant named Henry Lehman landed in Montgomery, Alabama. He opened a small dry goods store, and soon his brothers Emmanuel and Mayer joined him to form Lehman Brothers. In the early days, they weren't banking, they were trading cotton, which was the backbone of the Southern economy. They were flat out, accepting raw cotton as payment for clothes and tools, essentially becoming commodity merchants by accident. After Henry passed away, the brothers moved the headquarters to New York City in 1858 to be near the action. They survived the American Civil War and helped found the New York Cotton Exchange in 1870, which is a massive legacy. By 1887, they joined the New York Stock Exchange and began their transformation into a proper Wall Street powerhouse. They weren't just about cotton anymore, they started financing the massive railroads that were currently building out the entire United States. It's wild to think that a tiny shop in Alabama could evolve into a titan that would eventually move global markets. This was the era of the merchant bank, where your reputation and your family name were everything in the financial world. Under Philip Lehman, in the early 1900s, the firm partnered with Goldman Sachs to lead some massive retail IPOs. We are talking about legendary names like Macy's Department Stores, Sears, Roebuck & Company, and even Studebaker Automobiles. Robert Lehman took over in 1925 and steered the ship through the Great Depression and World War II like a pro. He was a visionary who backed emerging industries like aviation, serving on the board of the iconic Pan American Airways. The firm even funded the early days of television and film, supporting Paramount Pictures and 20th Century Fox. After World War II, they saw the computer age coming and invested in Digital Equipment Corporation before it was cool. By the time the 1990s rolled around, Lehman was one of the big five investment banks on Wall Street. They were financing skyscrapers and global tech, and for a long time, it looked like they could never actually fail. But the culture started to change, shifting from traditional advisory work to aggressive, high-stakes trading and massive leverage. They had successfully navigated every major crisis for over 150 years, but the housing market was different. The strategic pivot that eventually broke them started in the early 2000s when they went all in on subprime mortgages. Lehman bought up lenders like Aurora Loan Services and BNC Mortgage to control the entire pipeline of home loans. By 2006, they were originating almost $50 billion in loans every single month, which is absolutely hectic. They packaged these loans into complex securities and kept a massive amount of them on their own balance sheet. The smart money started to get worried because Lehman was using extreme leverage, peaking at a ratio of 31-1. This meant that for every $31 of debt, they only had $1 of their own capital backing it up. At that level of gearing, a tiny drop in house prices would wipe out their entire equity and leave them insolvent. They were essentially a giant real estate hedge fund disguised as a bank, and the market was having a bit of a wobbler. When the housing bubble burst in 2007, those mortgage-backed securities turned into toxic waste almost overnight. But instead of cutting their losses and being honest with the market, Lehman's management chose a much darker path. To hide the mounting debt, they used an accounting loophole known as Repo 105 to window dress their books. They would temporarily move $50 billion in assets off their balance sheet right before their quarterly reports were due. This made their leverage look much lower than it really was, tricked the rating agencies, and kept the stock price up. As soon as the report was public, they would bring the debt back on the books, which is a proper dodgy move. The Valukas report later revealed there was no business purpose for these trades other than to reverse engineer their financial health. It was a massive deception that left investors and even their own outside lawyers completely in the dark about the risk. In a high-trust environment like Wall Street, Once people found out you were cooking the books, the game was essentially over. They were flat out trying to maintain an illusion of stability, while the foundation of the firm was literally crumbling away. This lack of transparency is exactly what makes the smart money today so nervous when they see complex derivatives. If you can't see what's under the hood, you can't properly value the company, and that's when the panic starts. The face of this aggressive culture was the CEO, Richard Fuld, who was often referred to as the gorilla on Wall Street. He was famously combative and refused to admit that his firm was in any real trouble until the very last minute. Fuld reportedly took home nearly $500 million in pay during the decade leading up to the massive collapse. Even as the bank was dying, his wife Kathleen was seen shopping at Hermes, requesting plain white bags to hide her luxury purchases. Fuld even transferred his $14 million Florida mansion to his wife for just $100 to protect his assets. Lawmakers later called him a villain in a congressional hearing, but he insisted he was a victim of uncontrollable market forces. He blamed short sellers and rumors for the bank's demise, but the reality was that they were simply out of cash. The culture at the top was one of arrogance and greed, where no one was allowed to tell the boss he was wrong. It's a classic cautionary tale of what happens when leadership loses touch with the reality of their own balance sheet. This kind of hubris is exactly what we look for as a red flag when we are trying to optimize our entries today. Warren Buffett was approached to save Lehman in March 2008, but he spent a night reading their reports. He jotted down a list of red lights, noting that the management was hiding losses and refusing to take responsibility. Buffett famously called the situation an economic Pearl Harbor and walked away from the deal, saving his billions for better bets. Ray Dalio of Bridgewater was also sounding the alarm, warning that the financial system was about to experience a massive cracking. Dalio used his principles to predict the crisis, realizing that the debt cycle had reached a point of total exhaustion. He saw the systemic risk in the shadow banking system and knew that a beautiful deleveraging was no longer on the cards. Dalio's memos from that era are like a roadmap of exactly how the global economy fell into the Great Recession. These legends knew that when the numbers don't add up, the only winning move is to get out of the way. They looked past the hype and the fancy office towers to see the actual risk that was being hidden by management. If the smartest man in Omaha says no to a deal, you probably shouldn't be the one trying to catch the falling knife. Then there was Jim Cramer, who provided some of the most regrettable investment advice in the history of television. In early 2008, he was telling viewers that banks were fine and that they should keep buying the dip. His most famous moment was the "they know nothing" rant, where he screamed at the Federal Reserve to open the discount window. Cramer even recommended Bear Stearns as a buy just days before it collapsed and was sold for $2 a share. By October 2008, he flipped completely, telling everyone to pull their money out for the next 5 years. The problem was that the market bottomed just 5 months later, so anyone who followed him missed the massive recovery rally. It just goes to show that the media often fuels the panic, rather than helping you make objective, logical trading decisions. In this game, following the loudest voice in the room is a quick way to see your portfolio go up in smoke. You have to stay active and stay focused on the data, not the drama that you see on the news every night. Cramer's volatility is a reminder that being an entertainer and being a successful trader are two very different jobs. The final 72 hours for Lehman Brothers were absolute pandemonium at the New York Fed headquarters in Manhattan. Treasury Secretary Hank Paulson told the heads of all the major banks that there would be no government bailout this time. They spent the entire weekend trying to find a buyer, but Bank of America decided to buy Merrill Lynch instead. Barclays was the last hope, but the UK Chancellor Alistair Darling vetoed the deal because he didn't want to import the cancer. Darling didn't want the British taxpayer underwriting a failing American bank that was stuffed with toxic mortgage debt. By Sunday night, it was over, and at 1:45 a.m. on September 15, 2008, Lehman filed for bankruptcy. Employees were seen walking out with their boxes, and the Dow Jones plummeted over 500 points the next morning. Over $700 billion vanished from retirement accounts in a single day as the global credit markets froze up. It was the largest bankruptcy in history, and it triggered a chain reaction that nearly destroyed the entire global financial system. The interbank lending market stopped dead because no one knew who was actually solvent and who was secretly broke. Let's look at the current landscape of 26, where leading equity indices are trading at historic record highs. The Nasdaq is also hovering at all-time peaks, driven by the massive AI productivity miracle. Energy markets remain volatile, with oil prices pushing toward levels that threaten global growth. The IMF is warning about a sovereign bank nexus, where banks are holding too much government debt that is losing value. Ray Dalio is back in the news, warning that our ballooning multi-trillion-dollar national debt is the biggest problem we face. He compares today's geopolitical tensions and debt levels to the 1930s and says we could face something worse than a recession. However, unlike 2008, our major banks are currently flush with cash and have much higher capital buffers. But with tech valuations so stretched, any reevaluation of AI expectations could trigger a sharp tightening in financial conditions. We are seeing a divergence where the US is growing, but Europe and Asia are feeling the credit stress of global conflicts. It's a high-stakes environment where the smart money is staying cautious, despite the record-breaking runs on Wall Street. The lessons are clear. Leverage is a double-edged sword that can make you rich or leave you in the gutter. Transparency is the only thing that maintains market confidence, and once that is gone, liquidity disappears in an instant. We also learned that too big to fail is a dangerous myth that can lead to massive moral hazard for top executives. Today's regulators have more tools, but the speed of digital bank runs means a crisis can happen in hours, not weeks. Always keep an eye on the bond yields and the energy prices, because they are the true leading indicators of systemic stress. Don't let the exuberance of a record-high market blind you to the underlying risks that Dalio and Buffett always talk about. Success in this game isn't about the one big win, it's about staying in the game long enough for the math to work. We study Lehman so we don't repeat their mistakes, ensuring our gains are built on a solid foundation of actual value. Now, let's look at the psychology. We are currently testing the limits of investor confidence. Even when the long-term uptrend looks intact, the smartest players are watching for signs of exhaustion. Buying into these record highs might look like a golden entry, but high momentum markets often hide extreme risk. We see smart money coiling and waiting, showing caution after failing to break through major psychological barriers. Currency markets are reflecting this tension, showing a slow shift in how the world views safe haven assets. History shows us that a liquidity squeeze can happen in an instant when the market tries to push through multi-year resistance. If we can hold these key levels, we might see another leg up, but the margin for error is getting thinner every day. Optimize your strategy by waiting for confirmed strength rather than trying to front-run volatile geopolitical shifts. To recap, Lehman Brothers was a family empire that fell because of greed, 30-to-1 leverage, and dodgy accounting tricks. They hid $50 billion in debt using Repo 105 and ignored all the red lights from smart investors. The collapse in September 2008 was the climax of the subprime crisis and started the global Great Recession. Today in 26, we have record stock prices, but also record public debt and ongoing global instability. The sovereign bank nexus and tech concentration are the new risks that could transmit market stress into a broader crisis. We must use the principles of Dalio and the caution of Buffett to navigate these record highs without getting properly cooked. Liquidity is king, and as we saw in 2008, it's only there for you when the sun is actually shining. So, what's your move? Do you think the AI boom will keep us afloat, or are we heading for a sovereign debt reckoning? Let me know your strategy in the comments, and tell me if you think we've really learned the lessons of the Lehman crash. Smash that like button if you found this deep dive useful, and subscribe for more insights into where the smart money flows. Keep your positions tight and gains golden. I'll see you at the next close. Cheers.